Good morning, everybody, and welcome to my market update webinar for Wednesday, the 22nd of April. So appreciate all of you joining me. Apologize that I was a minute behind here. Actually, I guess it's still 11 o'clock, but had a couple of technical difficulties, but got those resolved and ready to get started. So welcome and thank you again for joining. Got a lot to cover today. Hi, David. So let's go ahead and get started. So first and foremost, what are we going to talk about today? I'm going to try hard, as I have every time, to not repeat information that I discussed in prior weeks. This is a repeat of what we did on Monday with a bit of new information, but prior week webinars are available on my YouTube page, so you can go to youtube.com/John Lone King and view all of my prior webinars. So what we're going to talk about today, as I do every week, is where are rates right now and where are they going? And kind of give you a primer of what I see happening, what's changing, and where we see things going. We're going to do a deep dive into kind of credit availability, where we're at with programs and what programs are gone. Why did things like down payment assistance go away? What can we do to make deals work in today's market? And we're going to talk about the future of home equity lines of credit. We're going to be doing a forbearance update and talking about the forbearance world, and I've got some new information on forbearance that just came out in the last day that is even newer than what I presented on Monday. And we're actually going to skip the updates from the title and escrow world. Jeff had nothing really to add from last week, and so he's not going to be in here today. So we're going to skip that part, and we're going to dive right in. Feel free, if you have any questions about anything, to post it in the chat. So as I am going through the presentation, I'll keep my eye on the chat button. And if you have something that you want to get clarification on, it makes the meeting much more interactive if you are willing and able to share with me your questions on chat. So let's dive in. If my PowerPoint will catch up. There we go. All right, so where are we at with mortgage rates? First of all, we're seeing stability, and stability is a super, super good thing. And so I want to kind of give you guys a quick refresher, as I have multiple times. What you're looking at is you're looking at a chart of what the Wall Street investor considers the value of a mortgage. In other words, if Wall Street likes mortgages, they don't want to earn as much in interest. And so when the numbers go up, when higher, that means interest rates should be lower, because Wall Street is willing to accept less income to have a mortgage because they like mortgages. If this bar moves lower, it means Wall Street's not happy with mortgages, and the investors aren't as interested in them, and therefore interest rates are going up. So just realize that down is higher interest rates, up is lower interest rates. So I like to think of this chart as up is good news, because what's good news with interest rates? That interest rates went down. Okay, what I really want to point out here, and I've said it a few times, but I really want to drive this point home because we're still seeing the same phenomena, is back here at the first week of March. This was the absolute best day in interest rates that I've seen in my entire career. We had interest rates between 2.75 and 2.99% on this day. And as I told you, down is bad news. But then we saw the market go right back to where it was, which means we should have had those interest rates back at 2.75 to 2.99. But that's not what happened. They stayed higher. They moved up significantly higher, especially in these trading days. This was the single most volatile trading day I'd ever seen in my career. It was followed by another highly volatile trading day. On this particular trading day, we didn't even offer rates. I've never had a day in my entire career where we did not even know how to price a loan, but we didn't, okay? Rates at this point had gone all the way up to 5%. We went from 2.99 to 5.5% at the worst of these numbers. The market should never have gotten that bad. We should never have seen this big of a movement in a single day. When these days go away from this chart, it'll look like all of these days are really big because the scale is skewed. This scale should not be this large. All I want to, ever since the last week in March, the market on the back end, what we pay as mortgage companies to the investor, is better than what it was back at the beginning of March. So we should be giving you better interest rates than what we were offering at the beginning of March, but we're still not doing it. We've consistently been way better in performance in investors' appetite. Now, the reason is because the investor is the Federal Reserve. They have almost completely taken over the market of buying mortgage-backed securities. And with them buying so much in mortgage-backed securities, they've kept interest rates low on the back end of the mortgage market. That has not translated to the front end of the mortgage market. That front end being what you and I talk to our buyers and borrowers about. Interest rates right now are hovering between 3.25% and 4%. Now, remind you, this right here was at 2.75 to 2.99. The market is better, and we're between 3.25% and 4% on average. A lot of reasons why. I won't go into that because I went into that in previous weeks, but there's a high cost to the banks right now because of the volatility and because of the fear of either A, rates continuing to go down, and now they're not going to get any income on those loans they closed because that person's going to refinance, or B, the person who did the mortgage is going to go into forbearance and they're not going to get any income, and as a matter of fact, they're going to have to carry a large burden of cost on the mortgage bank side when buyers or borrowers go into forbearance. And so those factors are creating the rates we charge borrowers to be higher, way higher than they should be. Now, what we're dealing with right now is stability, because this range of movement has gotten a lot smaller. That's what we want to see. So that's all good news. That's leading me to continue to talk about my advice for home borrowers, buyers, and refinancing. And very simply, if you're buying a home, rates are amazing. 3.25% to 4%, amazing interest rates. So when you have the opportunity to do a loan at less than 4%, jump on it. Who cares if it's at 3.75 or 3.25? It's an amazing interest rate. Lock it in and don't look back. Because your focus, as you guys know better than anybody else, is finding the right home. And you can't time that right home to get into contract the day interest rates are super low. So jump on it, lock the rate as soon as possible. But if you're refinancing, I am strongly encouraging, and as a matter of fact, telling my clients, we won't lock your interest rate up front. You need to get fully approved before locking, because we're going to see that big difference between what the Fed wants to earn in mortgage rates and what we're charging should narrow. And so we're going to see much better rates. Now, what we can't control is other market dynamics. Oop, hold on. Can you guys hear me okay? Is that any better? Hello, Steve, you got me? Okay, Steve, I think it's on your end because I got 2 thumbs up from other people saying they can hear me fine. So, all right, thank you for notifying me of that though, Steve. Okay, so what we're dealing with is, I can't guarantee you rates are going to go lower. What I can tell you is the Federal Reserve has an unlimited checkbook. They print the money. And mortgages are something very important to the growth of the economy, to the housing market, and the housing market is important to the economy overall. And so the Fed will continue to buy mortgages and keep their side of interest rates low for an extended period of time. And so as these issues that are causing mortgage banks to charge higher than necessary interest rates start working themselves out, I expect to see rates to drop further, which is why I'm telling people who are refinancing, don't lock your interest rate until we're done, because there's a huge cost for freezing your rate for 60 days. And there's no worry that rates are going to get worse in the next 60 days. I don't know if they're going to get better, but I know they're not going to get worse. And if they do, it's only temporary. And so instead of freezing the lock for 60 days on a refinance, let's wait until you're done with the mortgage loan approval. And that way we're only freezing it for 15 days. It makes the loan a lot less expensive because the bank is not holding on to the risk of rates changing. Even though we don't expect them to change, we still have to pay for that risk, and we pass that risk on to you. It's kind of like buying an insurance policy you don't need by locking a loan for a long period of time. So my rate outlook, I expect rates to stay low for the next year or longer. The Fed's in this for the long haul, and there's a lot of other dynamics that come into play when it comes to recessionary times. In recessions, interest rates stay low. Also in recessions, 3 out of the last 5 recessions, housing prices went up. You need to pass that message on to your buyers. And the truth is, the most recent recession, the Great Recession in 2007-8, that was caused by the housing market and the mortgage market. And that is kind of a wild card. What I mean by that is that of the 2 times of the last 5 recessions that housing prices dropped during a recession, one of them, a recession, was caused by housing. So clearly housing price was dropping because housing was at the epicenter of the recession. Just keep that in mind as you're talking to people who are a little nervous right now, because I'm hearing it from my clients. I'm not sure if now's the right time to buy a home. I'm not sure if now's the right time to make a move with the recession. I'm worried about housing prices dropping. 3 out of the last 5 recessions, housing prices went up. 5 out of the last 5 recessions, interest rates went down. So we're going to see interest rates stay low for the next year or longer. All right, any questions you guys have about interest rates, feel free to post them into the chat. Otherwise, I am going to move on and talk about housing credit availability. So this is a report. I don't want you to get too caught up on the scale or what it means. Essentially, what this is referring to is how easy is it to get mortgage credit. So it's credit availability index, and this goes back to 2011. So in 2011, the market was super, super tight, like super tight. It was very hard to get a mortgage. My industry was a bit backwards because in 2007 and 8, when prices were super high, everybody was loose with their mortgage guidelines. And then in 2011, when prices were super low, we were tight with our guidelines. It was really backwards, and I can go into details on why, but for the sake of time, I won't go into that right now. What I want to point out is you'll see is guidelines 2011, 2012, they dipped a little bit down in late 2012, but then the guidelines started relaxing, tightened a little bit in late 2013, and the guidelines kept relaxing over and over and over again. We kept getting looser and looser and looser. Here's what happened in mid-2015. We really opened the floodgates to alternative loan programs, specifically what we titled non-qualified mortgages. And non-qualified mortgages are mortgages that essentially were subprime under a new name. And those non-qualified mortgages became a lot more popular. People with really, really low credit scores, people, I mean, I'm talking about, under 550 credit scores. People who needed stated income, or they wanted to use bank statements to prove their income. People who wanted to buy investment properties and ignore all the rest of their debt and only pay attention to the debt on that investment property. There were programs to do that too. And those programs became prolific, and we had a lot of jumbo loan guidelines opening up. We had a lot of expansion in high loan to value jumbo loans. There were programs that were doing 90 and 95% loan to value on $1 million loan. Okay, all of this led to a significant expansion in credit availability. And then COVID-19 happened. And you see right here that credit availability dropped significantly. But what I want you to pay attention to is that where we are right now is right here in the history, takes us back to mid to late 2015. And mid to late 2015 is when all of these alternative programs and jumbo loans started expanding. That's what we've lost. So I don't want you focusing on the negative of saying, oh my gosh, John, credit availability has fallen so much. That makes for great television, great headlines. But the truth is, credit availability is just back to where it was 5 years ago. And it wasn't that hard to get a loan back in 2015. So it's not the end of the world. And I need to make that clear, because even some of the information I've been giving over the last 3 or 4 weeks, a couple people have told me, hey, John, you're talking a lot about what can't be done. And I realized that I too was falling victim to, hey, giving you awesome updates and accurate information, but it became overwhelming to some people in the perspective of what can't we do, what can't we do, what can't we do? And so I thought this was super important to point out that yes, we've lost some programs, but guys, we're in great shape and significantly better than we were in 2011, 2012. And I don't see us losing a whole lot more programs. I'll talk about that more in a little bit, but there's a couple of things I'm concerned about, but big picture, it's not going to get back to where it was in 2011, 2012. So let's talk about a refresher on what we've lost. Jumbo and non-QM loans are almost completely gone. So a jumbo loan, depending upon the market that you're in, $510,000 is the national limit for conventional loans. FHA, depending upon the market, has a lower limit than that. In certain counties that are considered high-cost counties, you can go higher in purchase, or higher in loan amount, and still be considered a conventional loan. So for example, Sacramento and the 5 counties that make up the Sacramento County MSA, that's about $560,000 is the cap for a conventional loan. But that loan that is above the 510, but below the 560, what we call high balance loans, they've become much more expensive. So even though it's still a conventional loan, it's a much more expensive conventional loan. And so if you're in the Sacramento area or if you're in the Bay Area and you've got high balance loans, be aware high balance interest rates are higher than traditional conventional loans. Depending upon the circumstances, it could be anywhere from 1/4 to 0.5% higher. Still super, super good interest rates, but definitely higher than what the traditional conventional loan is compared to the high balance conventional loan. But once you get over that threshold, whether you're over the national threshold of 510 like San Joaquin County is, or in Sacramento County area, you're over 560. I believe in the Bay Area at 760 something. Now you're in jumbo territory. A month ago, I had 11 jumbo investors. Today I have none. We literally have 0 jumbo investors left that are willing to lend through correspondent or third-party channels. So now that says, John, where do I go to get a jumbo loan? You got to go to the big banks or the small community credit unions and local banks. Those are the only people that are going to be doing jumbo loans for the foreseeable future because they're lending their own money. And right now, credit liquidity in those markets is really, really tight. It's not very liquid. And so you have to go to the source to get the money. I'll tell you that 2 big banks that have publicly announced changes in guidelines, Chase Bank has said they're not doing any loan for anybody if they have under a 700 credit score. They're not doing any loan for anybody unless they have at least 6 months of payments in reserves, and they're not doing any cash out refinances for anybody at all. Wells Fargo came out and said on their jumbo loans, they're only going to do jumbo loans for clients who have at least $250,000 on deposit with Wells Fargo. So you can see the banks are saying, hey, we'll lend the money, but we're really, really tightening our guidelines and you need to come to us. So for the foreseeable future, you've got to go to the bank. And I had said in the past that jumbo loans are like the wild, wild west. Everybody has a different set of guidelines. I'll tell you it's even worse right now. Because right now you've got individual banks that are tightening their own guidelines and making it even more restrictive for lending out of, from the bank side of it. The biggest concern is actually about the stress test, because the banks not only are they concerned about performance of mortgages, but they're under pressure from the federal government because of the fact that we're dealing with an economic issue that is exactly what the stress tests were designed for back in 2008 when the market crashed and the banks had to get bailed out. Now those stress test triggers are kicking in and the banks have to limit how much money they can lend. So the jumbo loans are gone, non-QM mortgages are gone. I expect jumbo to come back a little bit better with the banks. I don't know if they're coming back to private mortgage companies anytime soon. I personally think non-qualified mortgages are gone for quite some time. So we're gonna, again, that's my own opinion. We'll see whether it comes back or not. But again, those are the really outside the box, really high interest rate programs. They're good for the right person, but they're not originating those loans at all right now. FHA and VA loans are continue to get harder to get. I'll show you in a minute when we talk about forbearance on really where that's coming from. We also need to be more concerned about lower credit scores. Our minimum FICO is 620 on FHA now. Down payment assistance programs are on hold. So I'll talk to you in a minute about that piece of it. And then we also have no renovation loans or holdbacks for the near future. And the reason why is because with the shelter in place, we're concerned about the homeowner getting a contractor in to actually get the work done. And we've had people who have done renovation loans and holdbacks, and they've said, we're not willing to get a contractor out here. You guys have to wait. And there's a huge cost to the bank when that work is not completed because we can't sell the loan to Fannie or Freddie or whoever we're selling it to. And so we're holding that on our line and paying it out of our checking account until the time at which that work is completed. And that's a huge risk that we're not willing to take right now as an industry. All right, so why are guidelines tightening? Well, I think I already covered a lot of this. You've got illiquidity in the jumbo market, and you've got major banks that can't lend because of stress testing. But here's what's happening on FHA and VA. The investor, Wall Street, and by the way, what we're dealing with is, and I've covered this before, so I'm not going to go too deep into it. The bottom line is Wall Street investors are investing in mortgages, and they're refusing to bid on FHA loan pools. It's basically creating a situation where you put something on eBay and you say, hey, I've got this listed for a starting price of $100, and crickets, like nobody's bidding on it. That's exactly what's happening right now with some FHA loan pools. Investors are afraid of Ginnie Mae loans, and they're literally not even bidding. It's not like, hey, I'll give you $70 for it. They're like, I'm just not bidding at all. So when you have crickets, it's hard to know what something is worth when nobody's even willing to offer something. You guys know how that is when you list a house and it's been on the market for a month and not one showing, not one offer, not one anything. That's what's happening right now for loans that companies have funded that they're trying to sell to Ginnie Mae. So John said, is the Hold on Down Payment Assistance Summit or the whole industry? I will cover that in just a moment. So great question, John. And guys, so we're dealing with mortgage banks having to hold the risk, and forbearance concerns are more likely to hit low FICO borrowers. And I'm going to cover that in a couple minutes when I talk more about the forbearance challenges and how the mortgage industry is dealing with it. The other thing I'll tell you, it's kind of new that I haven't talked about much before, is warehouse banks. So I have mentioned before, a warehouse bank is kind of the big old American Express card that mortgage companies fund their loans using. And then we pay it off in 2 weeks to a month, worst case, a month and a half. And we pay off that equity, that American Express card, it's a charge account. And we pay it off by having sold the loan to Wall Street or to Fannie Mae or Freddie Mac or FHA or VA. And so the challenge right now is mortgage banks warehouse banks are worried about being stuck holding the bag. If you're interested in some research or some historical data about this, there's a company called Taylor, Bean & Whitaker. And Taylor, Bean & Whitaker was the victim of this exact thing happening, and the warehouse bank got stuck in 2008 with a significant number of loans that they could not sell anywhere. A warehouse bank is not in business to own mortgages. That's kind of like if you had I don't know what the best American Express card is, the platinum, the super platinum, gold, diamond plated, black. I don't know what the heck it is. I have two of them, so I confused them, obviously. But you go out and you buy 4 Ferraris on that super platinum black American Express card, and then you decide not to pay it. Well, guess what? Now American Express owns 4 Ferraris. That's great they get 4 Ferraris, but they didn't want the 4 Ferraris. And that's exactly what the mortgage warehouse banks are worried about. They don't want the mortgages. They're not in the business of holding them long term. And now they're going to have to turn around and sell them at a discount and lose money. And so the warehouse bank is actually driving a lot of these challenges. And a great example is Chase Bank. Chase is a large warehouse lender. And so Chase has said they won't accept anything under a 700 credit score, including loans that they're funding as a warehouse lender. So that means that if you owned a warehouse bank, and you knew that the mortgage company that you're partnered with has you and Chase Bank as a warehouse option, well, then you're automatically going to get everybody under a 700 credit score. And that's not a position you want to be in. It's called adverse selection. And so that's what we have to be careful as an industry, is we don't want to be selected as the lender of choice for all of the tough deals or all of the challenging circumstances. And that's a little bit of what I'm going to get into when I talk to John about down payment assistance and whether it's summit funding or the industry. It's adverse selection. Nobody wants to be the only one accepting a challenging circumstance, because that means their entire portfolio is going to get filled with that. And in this case, warehouse banks are cutting their guidelines because they are worried about, hey, if you're only working with me and Chase, then you're giving Chase all the good stuff and me all the bad stuff. And they don't want to have to do that, okay? All right, so let's go exactly to where John's question was about down payment assistance. So why did down payment assistance dry up? So here's the reality, and John, I was already gonna say this, but you beat me to the punch. Down payment assistance programs did not go away. CalHFA is still operational. GSFA is still operational. The down payment assistance entities have not changed anything. CalHFA just changed their rules now. They lowered their debt to income ratio effective May 1st. So they are tightening their guidelines a smidge. That's not the problem. The problem is a couple of things. First and foremost is forbearance, and I'll talk more about that, but we've got major concerns with people going into forbearance as soon as they buy a home. As a matter of fact, I was listening to a webinar the other day, and they were talking about how some realtors, and nobody on this call, but some realtors are advertising, buy a home and get 12 months of no payments. And their strategy is simple: buy the house and then file for forbearance right after that, because you're legally allowed to. And you are legally allowed to. There is nothing legally stopping a brand new home buyer who just bought a home from filing forbearance before they make their first payment. The problem is the mortgage bank. We're stuck holding the bag. Okay, some new information just came out from Fannie Mae and Freddie Mac this morning that help a little bit with that. But the truth is we're in major risk when somebody goes into forbearance at the beginning of the loan. And so that's one thing, that when we have down payment assistance buyers, those buyers already have a lower credit, or excuse me, lower income, lower assets. So if they didn't have enough money for the down payment, they likely didn't have any money for reserves. And therefore, if there's any small change to their income, they're likely to be unable to stay on top of making their monthly payment. And demographically, a lot more service workers, people in those types of industries don't have the ability to save up a down payment, and they're more likely the people who make up the pools of down payment assistance buyers. And so there's a concern there about performance on down payment assistance loans, just like there's a concern about performance on low credit score FHA loans. But on top of that is the concern about buying or being able to sell the mortgage to the final investor fast enough. These down payment assistance loans are highly, highly scrutinized. And if we don't get the loan sold to the investor in 30 days, then we are on the hook for 100% of the assistance funds, which is typically anywhere from $10,000 to $25,000. And our agreement with the down payment assistance entity, because CalHFA does not own the loan. CalHFA, as a matter of fact, sells their loans to a company called Lakeview Servicing. And so Lakeview sets the rules, Lakeview buys the mortgage, but Lakeview's taking forever to scrutinize these mortgages. And so if we fund a loan, our agreement with CalHFA is if we don't have it sold to Lakeview in enough time for Lakeview to take over the servicing, we write the check to CalHFA in order to cover the down payment assistance portion. They literally, we don't have to write a check. They have an ACH out of our checking account. They jump in and they yank the money out. And so if you were a mortgage bank and you knew all of those factors were at play, and did I just lose my, can you guys see my screen still? Because my screen just, there we go. All right, cool. I don't know what you guys saw, but all right, cool. Did you see what I saw? Yes? Okay, now it went away? Cool. All right, good thing I wasn't hijacked and had some crazy stuff, because I've heard those stories too. All right, so that was only my computer. So if you were a mortgage bank and you had this dynamic happening right now, and you saw some of your peers pulling out and saying, yeah, I'm not willing to take that risk, do you want to be the last one willing to do it? Do you want to have adverse selection and have everybody coming to you saying, oh my gosh, John, you're amazing. I heard you can do down payment assistance. I'm going to tell all my friends that they can come to you, and you're going to get every realtor's down payment assistance loan for the entire state of California. Well, that's great for me, but my company will crumble. And we've got to look long-term at the health of the company and the health of the industry. And so, John, the answer is, it is I don't know of any bank that is still funding down payment assistance loans. So is it Summit? Yeah, it's Summit. But is it every other bank that I know of? Yeah, it's every other bank that I know of has made the same decision as Summit. So can I say it's the entire industry? No. Can I say it's the actual down payment assistance entity? Absolutely not, because the down payment assistance programs have not gone away. But nobody is willing to take that risk on down payment assistance loans. And so I know of nobody who is participating. A good example is FHA says you can go down to a 500 credit score. They actually haven't changed that rule. But I don't know anybody in the lending industry that's participating in FHA loans down to a 500 credit score. We used to go to a 550. Now we've raised our cutoff to a 620. And so there are allowable guidelines, just like the down payment assistance is allowable, but nobody is funding them that I know of because we're unwilling to take the risk for what the cost could be long-term, especially because there's very little profit in them. And so we do it somewhat as a loss leader. And I'm not telling you we lose money, but we make nowhere near as much money on down payment assistance loans as we do on regular loans. You add all that together, and I'll tell you that everybody, both independently and as a result of their peers getting out of there, has pretty much decided they're not going to do it. So any questions about why down payment assistance dried up, or any clarifications you guys need on what I just went through? All right, cool. John, did that help? Well, I'm sure you'll tell me if it didn't. All right, beautiful. So now I want to talk about how do we make deals work. I spent a lot of time over the last few weeks talking about the negative, and I want to be really, really clear about the positive, about what we can do. So the first thing I'll tell you is 3% down payment conventional. That's actually a piece that came out in the 2015, 2016 era, where conventional loans used to require 5% down, and they decided to increase home ownership by letting conventional loans go with smaller down payments. And Freddie Mac has a huge portfolio of 3% down conventional loans, much larger than what they were intending. And there's some concern out there about that. And so right now, 3% down conventional is a great option. I said futures to be determined because from what I'm reading in the tea leaves, I think there's a good chance that the small down payment conventional loans could go away. Now that just means we go back to 5% down on conventional and FHA becomes the product of choice for small down payments. And there's a lot of reasons why I think that the market in the mortgage world is gravitating more towards FHA than conventional on high risk loans. So the bottom line is we still have super, super small down payments. 3.5% down on FHA, currently 3% down conventional, 0 down on USDA and VA. USDA is an amazing product. It's still fully functional. You just have to look at geographically where you're buying. So 2 major restrictions on USDA is where they're buying, and there's income limits based on the family size. So I do a lot of USDA loans during certain market cycles. I think we're going back into a market cycle where USDA is going to be a product of choice to help people get in with 0 down payment. VA obviously is a 0 down payment option as well. But here's where I really want to focus, guys. We've got to start getting creative and talking to our clients and not be order takers. Because when somebody says, oh, I don't have a lot of money for a down payment as an order taker, we're like, cool, because I got down payment assistance programs. We'll help you out. My lender will hook you up. And I would, but right now I can't. And so we've got to help talk through other options with them. That means that we're talking about family gifts. Every loan program allows for a gift from family. Okay, so Bank of Mom and Dad is the #1 place to get down payment assistance from. And you probably don't ever have to pay them back. Plus, it's supposed to be a gift. And so if you choose to regift them back the money later in incremental gifts, I'm okay with that because I have nothing to do with it. But it's a gift, and mom and dad or whoever the family member is has to be willing to call it a gift and certify that it's a gift. So family gifts are huge. And the truth is, a lot of people have equity in their home right now. Mom and dad have equity in their home too. And so if mom and dad want to help you right now in buying a home, it's a great opportunity for mom and dad to take out a line of credit or do a refinance on their home. And it allows them to help out their kids in getting a home. And guys, the interest rates and closing costs on down payment assistance loans are significantly higher than the interest rate and closing costs without down payment assistance. So it actually is benefiting them by not using down payment assistance. They're getting significantly better interest rates, significantly better closing costs. So family gift is huge. Seller credits. I think that depending upon how the market rebounds, we're currently certainly in an environment right now where there are fewer buyers and fewer sellers, and I'm 100% seeing a lot more flexibility in the side of the seller being willing to look at seller credits. And so even though the buyer has to cover their own down payment through their own funds or through family gifts, they can use a seller credit to pay for closing costs, and that can really help somebody get into a home and make it a win-win for the buyer and the seller. 401k withdrawal. So I want to be careful about this one. What I'll tell you is if a buyer wants to get into a home and they have no other way to get into a house, then liquidating money from your 401k is a viable option. There's an opportunity cost. And we all understand how that opportunity cost works. And so I don't want to say, hey, it's no big deal to liquidate your 401k. But the reality is that if you had 30 grand in your 401k and it appreciates by 20%, you made $6,000. But if you take that 30 grand and use it to buy a $300,000 home, and that $300,000 home appreciates by 5%, you just made $15,000. And so your growth does not need to be anywhere near as high because you're leveraging a larger asset, and you're getting tax deductibility, and you have stability in your housing payment, because as a tenant, you have no idea what your landlord is going to charge you. You have no idea if your landlord's going to decide to raise the rent or decide to kick you out. And we've got to be having those conversations with our buyers and saying, hey, if you pull some money out of your 401k right now, if that's your only way to make it work, that is a better option. I'll cover that in a second, Randy, thank you. So that is a better option than staying as a renter. So Randy's question was, can they take 401k money out and repay within 3 years? Well, on Monday's call, I realized that I had a blind spot there and that I had not done enough research on that. I've done more research, but I'm still not a financial advisor or a tax planner, so I can only tell you my own understanding of it, which is yes, through the CARES Act, you have the opportunity to withdraw funds from your 401k. That withdrawal you do not pay the 10% penalty on, and you can pay the taxes spread out over 3 years. So you still have to pay taxes because when you put the money in there, it was tax-free. But instead of the government requiring you to pay the taxes on your 2020 tax return, you'll get to pay only, you have the opportunity to spread that out over the next 3 tax returns and pay it in 1/3 increments so that it isn't creating as big of a tax burden on you. So good opportunity, especially because by that time you're going to have a better write-off because you're going to be a homeowner with mortgage interest and property tax write-offs. Again, not a tax planner. Don't pretend to play one on TV. Talk to your tax advisor, talk to your financial planner. But guys, we have to get creative, and these options sometimes are better than down payment assistance programs anyway. The other thing is sell an asset, sell a car, sell your sister. I'm kidding. Sell something to generate money, because you can sell an asset and use that as funds immediately for a down payment. And so if you have that extra car in the driveway, if you have that car you've been tinkering on in the garage that you're supposed to, the project that you were supposed to finish, maybe you sell that and you use that for your down payment funds. There's even some creative options that we have to dust off, like FHA has a wedding registry program, where if somebody's getting married, they can actually get gifts of funds towards their down payment, and the documentation is nowhere near as challenging as normal gift circumstances. Because normally with FHA, every dollar you get in a gift, you have to get a copy of the bank statement from the donor, you have to get a copy of the transfer of funds. The wedding registry works a lot easier. I say dust it off because it's been a while even since I've looked into it, but it reduces the burden of paperwork, and there's some really cool ways we can help people that are feeling locked out of the market right now because of the lack of down payment assistance programs. That's the biggest challenge that we're dealing with, and we need to find these creative ways to help people buy homes, because there are absolutely great ways to make this happen. All right, if you have any questions about this, feel free to post them. I'm gonna move on to the future of home equity lines of credit. So my favorite bank to pick on right now is Chase Bank, only because they've been the most prolific in pulling back their guidelines and publicly announcing them. So Chase Bank announced late last week they are no longer accepting applications for home equity lines of credit. So if we think back to 2007, 2008, as the market started to fall, a lot of home equity lines of credit started freezing your available credit. I personally feel this is the first step to potentially going down that road again. So if one bank starts freezing their home equity lines of credit, maybe another one will think that's a good idea, and then we start getting into the same thing about adverse selection. And so we are going to run into situations where banks are not going to be willing to do home equity lines of credit and maybe even curtail your amount. I won't say we are, we could. Simply because of the fact that they're worried about performance of those, even if the housing market stays stable. There's still a lot of fear out there on the side of the banks. So the reason I'm saying this is not because the sky is falling, but it is a fact that if you or someone you know has your reserves, your rainy day fund in a home equity line of credit, and that's really important if that's your only source of rainy day funds, I'd consider pulling that money out and putting it in the bank for the next few months. At least until all of this shakes out. Sure, you're going to pay 5% interest on the money, and you're only going to earn 1/10 of 1% at your bank. But the reality is that having the access to the money, if you need it, is way better than what that cost is going to be in the short term. And then once we're all back to normal, put the money back against the HELOC if they haven't closed your line of credit. If they have, then make the decision on whether you keep it anyway or pay it down. So super, super important to understand that the first signs of cracks in the HELOC market are showing, and I want to point that out to you guys so that if it's something that you personally need to withdraw, or you've got a client who's going to be using home equity line of credit funds for something, they may want to draw down some of that line to be in a defensive position in case these cracks get a little bit wider. Hope that makes sense and hope that helps. I want to go back quickly and talk about verification of employment is still a major concern. So we're definitely verifying employment the day of or the day before closing. When I first rolled this out a few weeks ago, I said we are the absolute most conservative. Most banks are doing it within 5 days or 3 days. We're requiring it within 1 day. Almost every other bank I've talked to has come to match our guidelines. So we were the first ones to get there, but almost every other lender requires now verification the day of or day before closing, because we are mandated by Fannie Mae and Freddie Mac to prove that there has been no change to their stability of income up to the day the loan funds. Okay, so there's an additional component of this that I'll talk about in a minute, but the reality is we have an obligation up to the day the loan funds, and in some cases we have an obligation even up until the day Fannie Mae buys the loan, which could be 2 weeks to 2 months later. So major concern still on verification of employment. Quick update on forbearance. So I've been sharing numbers with you guys. I shared you some numbers last week. So these numbers are always a week behind. We're getting them on Friday. They're through the 12th. So literally they're 10 days old right now. And as of April 12th, what you're looking at here is the bottom line is Fannie Mae and Freddie Mac loans. The yellow line is all mortgages overall. The blue line that has skyrocketed is Ginnie Mae. That's FHA and VA loans have skyrocketed. And then other portfolio, private label and portfolio, meaning the bank owns the investment. They didn't guarantee it with the federal government. So we're talking about huge increases in these numbers, and I'll break that down a little bit better for you right here. So as I talked about last week, the numbers on March 2nd were super small. Like Ginnie Mae, FHA and VA loans, 0.19% of all of those loans were in forbearance as of March 2nd, next to nothing. By March 30th, that jumped to 4.25%, which is significantly more than what the overall total of mortgages had jumped. So as you're looking here on this page, you see the blue line was low. And then by the end of March, it had gone above the rest of the mortgages, significant increase in forbearance for FHA and VA loans, and that trend has continued. As of April 12th, we were at almost 6% of all mortgages and 8% of FHA and VA mortgages that have filed for forbearance. These numbers are expected to explode. That was April 12th. Remember, somebody's mortgage isn't considered late until the 30th of the month. They have a late fee on the 15th, but if you're not going to pay your mortgage anyway, who cares about the late fee, because they waive that when you're in forbearance. So as one speaker in a webinar mentioned, humans are procrastinators by nature. It does not surprise them that these numbers looked super low on March 30th, and this had been announced, I don't know, March 18th or something. And so they said, gosh, there hasn't been the flood of people asking for forbearance. The floodgates are happening this week and next week. We have 1 week left until people are going to be considered late for their mortgage. And it's now that people are really ramping up. As of last Thursday, one major servicer had said that over 10% of their entire portfolio, all of their mortgages, are in forbearance. And last Thursday was what, the 16th? I don't know what it was. Anyway, whatever, close enough. So we're talking about, we still had the second half of the month to go. There is a reasonable expectation that we could see up to 25%, 1 out of every 4 mortgages by the end of this challenge we're dealing with, being in forbearance. And I had told you guys a few weeks ago what that would mean to the mortgage industry and the cost to us, because the mortgage industry is responsible for making the payments to the investor. We've been fighting with FHFA and Mark Calabria, the head of the Federal Housing Finance Administration. So the FHFA oversees Fannie Mae and Freddie Mac. He finally threw us a bone yesterday. He said, hey guys, fine, I've solved your problem. I'm going to cap you at only having to pay the first 4 payments of anybody that's in forbearance. Well, that's kind of like saying, okay, so we've got this much money in the bank to work with, and if we had to cover a year's worth of payments, it's going to cost this much money. But you just capped it at 4 months, which means we're only going to have to pay this much. But that's still more money than we have. And so he didn't fix the problem. He threw us a bone. He said that means that, hey, mortgage banks now can plan for what their cost is going to be, and we won't have a problem. The reality is that's not true. So are they making progress? Yes. Are we happy that they did something? Yes. Are we hopeful that there's going to be more? Yes. Because private mortgage banks have nowhere to go to borrow the money to make those payments. And that could crash certain private mortgage banks, and it could cripple the industry. And so we need to be careful of that. Summit Funding is in really, really good shape. We don't have a large servicing portfolio, so we don't have a huge exposure there. We're kind of shifting gears now, and we're servicing everything we close, because as I said last week, the value of servicing has gone down so much that people who can't service their own loans have to charge a really, really high interest rate. But because we can service our own loans, we're now servicing 100% of them. Another update that came in just this morning: Fannie Mae and Freddie Mac now will buy loans that went into forbearance prior to their first payment. Up until today, if somebody had gone into forbearance before their first payment was due, that became ineligible to be purchased by Fannie Mae or Freddie Mac. And therefore, we are on the hook for the mortgage itself. We have to write a check to cover the entire dollar amount of the loan out of our operating account. Here's a couple of things about it. First of all, it doesn't include cash out refinances, and there's a lot of cash out refinances going on right now. So if somebody pulled cash out and they go into forbearance after we funded the loan, but before Fannie Mae buys it, which takes 2 to 8 weeks for them to buy the loan, then we are stuck with that mortgage. It cannot be backed by Fannie Mae or Freddie Mac. It cannot be sold to Wall Street. But here's the other thing we have to be able to prove. We have to prove the credit event, the reason they cannot make their mortgage payment and had to go into forbearance, happened after we funded the loan. I told you a couple minutes ago, we're majorly concerned about verifications of employment because we're on the hook to make sure that everything was copacetic, that they had all the same income at the time that we funded the loan. But now we have an additional burden, because if they go into forbearance before their first payment is made, which literally the first payment, I said 2 to 8 weeks. The truth is the first payment itself is never 2 weeks away. It's typically anywhere from 4 to 8 weeks away. So within that 1 to 2 months before they make their first payment, if they file forbearance, we have an additional level of documentation to prove that nothing had changed before we funded the loan, but we also have to prove now from the borrower what the event was after they closed the loan. In other words, hey, Mr. Borrower, I know you asked for this forbearance. I need to know what changed and why you now need a forbearance when 4 weeks ago, when you signed your mortgage loan, you had a job and everything was fine. And here's the catch-22 that we haven't figured out, because this rule just came out this morning. We're not allowed to ask for any proof from the borrower when they ask for a forbearance. So if I funded a loan a month ago and their first payment is May 1st and they call up my company right now and say, hey, John, we can't make our payment, we want to go on forbearance, I'm not allowed to ask for any proof. Yet if I don't get the proof that there was some kind of a job loss or economic issue that happened that caused them to not be able to make the payment when they should be able to make the payment based on their income when we closed the loan, then I'm stuck holding the loan anyway. Can you see the challenge from the mortgage banking side on why we're tightening the rules and what our fears are? Because we have a huge burden of proof on our side. And in case we can't even legally force them to give us any documentation, because we have to grant the forbearance and we cannot force them to give us paperwork, we can ask, we can beg, we can plead, but we can't make it a condition of the forbearance. And if they don't give us the proof, we're in trouble. We don't have the ability now to sell that mortgage. So we didn't solve the problem by Fannie and Freddie saying they'll buy these loans. Guys, major concerns about the health of the mortgage industry. There'll be some solutions, but there's going to be some carnage. There's going to be some mortgage banks that are going to go bankrupt because of this, and that's my biggest concern. So as a reminder to borrowers, forbearance is postponement, not forgiveness. How soon do you have to pay it back? You got to talk to your bank. Make sure it's your last alternative, because we're unsure how it's going to impact you in the future. If you can't make your payments and you go into forbearance, after the period of time when you have to pay it back, if you can't, now you go into modification, and that will impact your credit score for sure. So you need to make sure that this is your only option and that you have no other choice, because the long-term impacts of this are huge. What I'm telling clients very simply, and I'm being a little bit more gentle than what I'm about to say, but I'm basically saying, look, if you have money set aside for a rainy day, look out the window, it's raining. It's time to use that money to help make your mortgage payment. If you do not have the money to make the payment and the choice is pay my mortgage or feed my kids, feed your kids and go on forbearance and deal with the problem later. I'm not telling you don't do forbearance. I'm just telling you don't do it because it's a victimless circumstance and that everybody's going to be fine down the road. There are unintended consequences that are going to create challenges for you. All right. That is the end of what I have to cover. I have a couple of things I want to mention on the side. Before I jump into that, just a quick reminder, if you have other questions about anything, please post it in the chat right now and I'll address that. I am pushing this knowledge out to consumers as well. And so I need your guys' help. This afternoon, I'll be posting on my Facebook page, both my personal page and my business page, an event that I'm doing tomorrow night. So I am doing a 1-hour webinar from 5:30 to 6:30 on the topic of a market update to homeowners. And it really is the things that I'm talking about here. I'm talking about, hey, where are rates at? Is it a good time to buy a house? Is it a good time to refinance? And forbearance. And I'm really going to educate them on the pros and cons of forbearance, and not from the mortgage bank side, from their side as the consumer. And I did one of these webinars last night, and I made it clear to the group, like, hey, there are implications to the mortgage bank, but as a homeowner, that's not your problem. What we have to talk about are the things that impact you, like, yes, this will show up on your credit report. Yes, this will impact you down the road. Yes, you have to pay back the money. And so if you have any clients that you think could use that information, this will be a realtor neutral event. It is for me putting it on. Feel free to come and join yourself. I'll be also streaming it live on Facebook tomorrow night as well. So please go to my Facebook page this afternoon, you know me, John King, or my business page, John Lone King, and help me share that to get awareness of that event that I'm putting on tomorrow night at 5:30. If there are no other questions, and it appears that there are not, I will give you guys 8 minutes back in your life. Have an absolutely amazing day. Don't forget, I am not a nonprofit organization. So if you know anybody who's looking to purchase or refinance a home, I would love the opportunity to take great care of them and you. And I hope you all have an absolutely amazing day. See you later.